We're live. Hello, everybody. Welcome to our first Facebook Live for the tax year 2020. My name is Ida Celli, and I'm here with my colleague, Jerry Vidaratis. Hi, Jerry. How are you?
How's it going, Ida? How's everything?
Pretty good. You?
Pretty good. Pretty good. Well, safe and sound. We're, I think, tucked away at home. We're all safe and sound. I hope everybody who's watching this right now is safe and sound at home. So another year, another tax season that's coming. And in this case, we have, another Facebook Live, right? So, hopefully everybody will join us and ask us any tax-related questions they have. I will try to answer as many. We'll try to answer as many as we can today. So let's get to it. Let's see if we've got something. Do we have anything right now?
Okay. If you want to ask your question, just below the video in the comments section, write in your questions and be specific on what your question is. So as we're waiting for the first questions here to come in, why don't you give us a few dates that we need to keep in mind?
Well, the dates are the standard dates, right? I mean, we're talking about April 30th is your deadline date when it comes to filing your tax return. So always remember that April 30th is really your deadline date when you owe money, right? If you owe money on your tax return, you must file by April 30th. Otherwise, penalties will apply. And the penalties are pretty stiff. I mean, you're talking about 5% right off the bat the moment you're late. And then there's another, I believe, if I remember correctly, it's 1% for every month that you are late after that, on top of the interest that gets charged as well. Now, the amount owing date is also April 30th. You have to pay your tax bill by April 30th. I'm hoping that's going to change because of certain benefits like the CERB, where no tax was withheld in this case. So, I'm hoping, like I said, that they're going to extend that deadline. But as of right now, as we're doing this live today, your deadline for your amount owing is April 30th. Okay, so that is your deadline as well. All right.
Okay, and what about the changes for this year?
So the change for this year, of course, the big one is employment expenses. That's the big one, and more specifically, home office expenses. That's the big change that's coming about this year. So the government has introduced some great measures in this case. One specific change that they've done is introduce a new method of claiming your home office expenses, which they call the temporary flat rate method. Okay, so that's good news. That's good news for everybody as the temporary flat rate method, in the sense that instead of having to go through the administrative red tape of claiming home office expenses, usually you need a specific form signed over by your employer. You need to keep your receipts as far as your eligible expenses. All these things go away with a temporary flat rate method. You don't need all those documents and all those requirements. All you need essentially is that for 4 consecutive weeks last year, okay, in 2020, you were required to work for at least 4 consecutive weeks. You were required to work from home. You're required to work from home for more than 50% of the time. Okay. And that's all due to the pandemic. The moment you meet that basic criteria, okay, then you are entitled to the temporary flat rate method. And the flat rate method is simply $2 per day for every work day that you had last year that you were required to work from home. Okay. Now, the deduction itself is capped to $400. Okay, as a deduction, which means if we take the $2 a day factor, you're talking 200 days that you can claim, 200 work days that you can claim for this new temporary flat rate method, as they call it. So that's great news, because you don't have to keep receipts. You don't have to prove anything to the CRA. You don't have any documents to provide either. Like, for example, if you're under your normal circumstances with home office expenses, you need to have your employer sign off on a specific form, which we commonly call the T2200. And this year they've introduced a simplified one called the T2200S. Okay, so your employer normally has to sign off on this to allow you to claim your home office expenses as a deduction. You don't need to do that with a temporary flat rate method. Okay, but you do have the choice. You could go with what's called the detailed method. I know I'm being wordy, I understand, but I'm trying to be complete.
We have questions
here.
Oh,
we got questions. Awesome.
We do.
All right, let's go.
Sean, he wants to know, if you work for one company and they switch jobs to another company, are they allowed to claim the $400 credit for each employer.
Yes. Yes, absolutely. It's not, you could have as many employers as you want and claim home office expenses. So as long as you meet, now it depends what you're going to do. Are you going to claim what they call the detailed method, where you actually itemize your receipts, or are you claiming the temporary flat rate method? For a temporary flat rate method, you're just making one claim because it doesn't matter how many employers you had. As long as you're required to work from home for at least consecutive months or 4 consecutive weeks, then you claim it. If you go with a detailed method, okay, where you're actually itemizing your home office expenses, then you're going to have 2 claims to make. Okay, you have for each employer. Okay, that's essentially how that would work. So yeah, no problem. You could claim it for both. There's no issue there.
Okay, but the maximum is still $400.
That's for the temporary flat rate method. If you choose the detailed method, there is no maximum. No, there is a maximum. It's up to your employment income. Okay, so essentially you're capped at your employment income, which obviously is going to be more than $400, which is the temporary flat rate method.
Okay, thanks, Jerry. We have a question from Anna.
Hello,
If
Anna.
my employer paid us $500 for home office expenses since we are working from home, and the government introduced the $400 flat rate, can I claim $900 or just the $500?
Listen, if you were reimbursed, the answer to that is it depends if the reimbursement has been added back to your employment income or not. That's really the answer. If your reimbursement is what the government calls a taxable reimbursement, meaning your employer included it as a benefit on your employment income. So on your T4, you're going to see a specific box, can be box 40. If you see a box 40 there with that amount, then it's likely that that's included. Then it is included in your employment income. Then you could claim the full amount. You could claim. You're not claiming 900. You're not claiming what your employer paid you back. You're allowed to claim your 400. Okay, that's essentially what that means. Now, if you received what's called a non-taxable reimbursement, meaning that it's not included in your employment income, okay, then at that point, it is the net that you're allowed. And in this case, you will not be entitled to the $400 deduction because you've been reimbursed, okay? And now, if you choose the detailed method, okay, where you're itemizing your expenses, okay, you're actually claiming your actual expenses, okay, and your expenses are above that $500, then you claim the difference, okay? That's for non-taxable reimbursement. If it's taxable, you're claiming the full amount in either method because you are paying tax on the amount that your employer has reimbursed you.
Okay, we have a question from Chad. He received a Serb, a T4A, but doesn't know where to enter it in the income in UFile. He can't find the box 197.
Okay, so for the box 197, usually you'll find it in the other income box. So I'm just going to call up that section here. Just give me one second because I just got to get to it. Okay, so let me go here. So usually you'll find the other income. Look for box 28. There's a box 28 plus usually. Okay, within UFile. So I'm just going there now, just going to confirm it for you. So make sure you add the T4A slip, okay, within your interview setup. Just make sure you do that. Okay, so I'm just going there now. Okay, and then once you're in your T4A, go to your box. There should be a box called 28 plus. Okay, once you're in there, click on the drop-down menu. It's going to be a long-winded drop-down menu that you're going to see there, and what box 197 should be there. I'm just going there now. I'm going to confirm it. Yeah, it's box 28 plus where it says other information. And then you scroll down and you should find 197 and it's right there. Yeah. So box 28 plus other information.
Okay. Edward has a general question. He's reached 65 and he wants to know if there's any tax credits he can take advantage of.
So the first one you're going to be entitled.
And he's still working full time.
He's still working full time. Okay. Yeah. Okay. So one off the bat that I could think of, the moment you turn 65 is the age amount. Okay. So that's a non-refundable tax credit based on the fact that you've turned 65. Okay. That's essentially what it is. So you get a credit based on that. I can't remember offhand what the total amount is, for the age amount, but you do get that additional credit because you turn 65. Okay, so that's the age amount. As far as you still being employed, it also depends on the province that you're in. That you're still entitled to the Canada employment amount. Okay, that's the non-refundable tax credit based on your employment income. You were collecting it all these years. Okay, since it was announced, you will continue to collect it, even though you are 65 and above. That the age does not matter. It's the fact that you have employment income. Now, just throwing it a shot in the dark here. If you are in Quebec, okay, then you would get the additional one for experienced workers. Okay, there's a non-refundable tax credit in Quebec for experienced workers. If you're 60 and above and you're still working, you can collect that credit as well. Okay, so that's just off the top of my head. That's what I could think of for the fact that you turned 65.
Okay, David, I sold some stocks in 2020 at a loss.
Okay.
How do I refile to claim the loss against a taxable gain in 2019? Do I have to wait until my 2020 taxes have been filed?
No. Well, you're gonna do what's called a retroactive. You're gonna do a carryback. Sorry, it is retroactive, but the technical term is a carryback. So it's a specific form. It's the T1A that you produce with your 2020 tax return. Okay, UFile has it. Okay, we support it. Okay, you simply go to the capital gains section in UFile. And or you go to losses, excuse me. It's actually the losses section, and you go there and you simply call it up. And what you do is essentially you complete the form T1A with your tax return. You stipulate on the form that you are carrying back the loss in 2019 against your gains in 2019. When you transmit the return with NetFile with the T1A, the government will receive your request for the T1A and will adjust your previous year's tax return for you. Okay, so there's nothing for you to do. Just make sure that you generate the T1A form. Like I said, UFile supports it. We have it. The T1A gets transmitted with your 2020 return. Okay, so you won't notice anything right away. Your amount owing or your refund is not going to change for 2020. But what's going to happen is when you transmit it, your return with the T1A, government gets your request and they will adjust your 2019 and they'll send you the difference afterwards.
Thanks. Now, Kathy. Hi, Kathy. My husband and I split our income, which puts me over $3,000. And I have to pay quarterly while he only pays a little over than $300.
Yes.
Using UFile, can I do something to lower my portion to be paid below $3,000?
By splitting, I'm assuming pension income splitting. Could that be? Is that what she? I mean, that's the only income that's splitting that you could split in this case. Basically, the only thing what you could do offhand is split less. Okay, that in other words, take on less of your spouse's income. The only catch, though, to doing that is that your combined result on your tax return will be worse off. Okay, so that's essentially that's the bad side of doing that. Okay, but yes, you can do that by simply, like I said, in this case, not transferring as much from your husband to you. Okay, the other thing you could do as well is maybe claim more of the transferable credits between you. So, for example, if you have donations or medical expenses, try to claim them as much as possible on your return instead of your husband's return. But like I said, the caveat is, yes, it will get you below $3,000, but your combined result will be worse. Okay, for you and your husband. Okay, if you do that if you don't allow UFile to do these transfers automatically.
Okay, the next question is from Alex.
Mm-hmm.
If I win some U.S. funds in a lottery or otherwise,
yes.
The U.S. government withholds 25%.
Yes.
Do I simply show this as a tax credit, or can I get the U.S. government to release the funds to me since of the a tax treaty exists?
I would go with the tax treaty. The reason being, what you're saying about the credit is what's called the foreign tax credit. So just a little primer what the foreign tax credit is that if remember that in Canada we are taxed on our worldwide income. So regardless of where you've gained your income, as long as you're resident in Canada, you have to declare that income and pay Canadian tax on that income. Now, of course, if you gained your income in a foreign jurisdiction, it's likely you pay tax on it. So now you're paying tax in the foreign country and you're paying tax in Canada. This is where the foreign tax credit comes in. The foreign tax credit allows you, the federal government here gives you credit for the fact that you've already paid an income tax at the other country, okay? And then if the Canadian tax is higher than the foreign tax, you only pay the difference, okay, in Canada. That's essentially what the foreign tax credit is to avoid double taxation, okay? Now, the problem with lottery winnings is that lottery winnings are tax-free in Canada. They're not considered a taxable income in Canada. So how can the federal government here in Canada give you a credit for an income that's not taxable? You understand? It doesn't work. So your best bet is you go with the treaty, okay? If the treaty allows you to recoup some of that money, go by the treaty.
Okay, Jen has a question. I guess this is going to be a lot of people is going to ask this question.
Yes.
Where do I claim the simplified work from home $2 a day credit?
Okay, that is purely employment expenses. Okay, so that's considered employment expenses in this case. So if you're using UFile, all right, what you simply do in your interview setup, okay, is that in the employment section, you're going to have an option called employment expenses. Okay, so you're going to have a section there in your interview setup called employment expenses. You tick the box, you click next, okay, and then the employment expenses section will appear just underneath your T4 slip, okay, on the navigator on the left. It's going to appear just below it, and then the first option will be your $2 a day deduction, okay, which the government calls the temporary flat rate method. Okay, so click on that, enter the number of work days that you were required to work from home for more than 50% of the time due to COVID, and you got your deduction at that point.
Okay. Next question. Our son is 17, but worked part-time all during 2020 as a grocery clerk. Okay. Because he's under 18, do we have to claim his income if he were claiming him as a dependent?
Yes, absolutely. If you are a single parent, okay, and you had that, and that child is your dependent, and he was 17, basically what the rule is that your child had to have been less than 18 at one point in the year. So even the year that your son turns 18, you're still entitled to the eligible dependent amount because you meet the criteria of at one point in the year, okay? Now, yes, for eligible dependent, the claim is the basic personal amount minus the income your child gained in the year. So you're only allowed to claim the net amount for the eligible dependent amount. Those are the rules. And then the moment your child is 18 throughout the year, you lose the claim. But remember, only single parents can claim this. Okay, so you can't be a married couple and claim eligible dependent. Okay, you had to have been without a spouse at one point in the year in order to claim the eligible dependent amount.
Okay. Now we have Roger and Sean that again are asking about the T2200S.
Yes.
Where to find it in UFile, and the $400 simplified credit. Where do we find it in UFile?
Okay, so I already stipulated it. So what you do is in the interview setup, okay, of UFile. So that's the menu where you choose the sections that are relevant to your tax return. Okay, you simply tick the box next to employment expenses. So go to the employment section there, and there's going to be an option there for employment expenses. Tick the box there, click next, and then on your left, you can have a section called employment expenses. Choose which method you want. If you want to go with the temporary flat rate method, remember that there is no conditions of employment for that scenario. Okay, you don't need a conditions of employment if you're going with a temporary flat rate method. If you're going with a detailed method where you're actually itemizing your expenses, then you do need a T2200S. Okay, and at that point, you simply choose one of the other options where they tell you, where it essentially tells you working from home. Okay, we're under the detailed method. Okay, so you simply click on that, and it should provide you with a T2200 section within there. Okay, so once you've chosen one of the detailed method options, which are the next two, the first one is the temporary flat rate. The next two are the detailed. You have to determine whether you're a commission or salaried employee. It's very likely most people who are listening to this right now are salaried. So choose the third option. And then once you're inputting your expenses, you're going to see an additional section called employment conditions. Okay, you're going to see it there. Click on that, and that is your T2200S. Okay, that's going to be the form, your conditions of employment, which remember, your employer has to sign off on. Okay, so your employer has to sign. Otherwise, it is not a valid condition of employment. Okay, so your employer has to sign off confirming that you're required to work from home. But that's only if you choose the detailed method, not the temporary flat rate method.
Okay, thanks, Jerry. Okay, we have a question from Alina.
Mm-hmm.
Can I claim my mom and my father as dependent if I am married and they are married? I sponsored them and I have to support them. They have no income.
The only way you can claim them is if they have what the government considers an infirmity. Okay, meaning that a doctor, you have a doctor's note that says that your parents require help. Okay, it require help. Essentially, they need your help in order to be able to do daily activities. Okay, now if you have a disability certificate, you're right in there. Okay, but you don't need necessarily a disability certificate. You need, at the very least, a doctor's note stipulating that your parents have an infirmity. Whether they are married or not, or whether you are married or not, does not matter. We're talking about the caregiver amount in this case, the Canada caregiver amount. But in order to claim the Canada caregiver amount, you have to show that they that they have an infirmity, and you need a doctor's note for that.
Okay, next one. Sorry, I won't pronounce the name. I'm afraid to get it wrong. So it's either Mr. or Mrs. Konda. Okay, my parents are with me all of 2020, and they have their PR, and we're not working, and so they are completely supported by me. Can they be added as dependent on our family income?
Same thing. It's you need an infirmity. Okay, so the only claim you can make for your elderly parents is the caregiver amount. But to get the caregiver amount, you need an infirmity. Okay, so you have to have some sort of a medical condition that requires you to help them. Okay, you need a doctor's note that stipulates this. You can't simply claim them as dependents. Okay, it doesn't work. Okay, you need an infirmity in this case to be able to claim them. Just like the other question, it's the same answer.
Okay. Omar, I have to declare taxes for another person. Do I need his CRA Canada password in order to send his tax declaration by UFile?
No. If you are producing a return for a friend of yours, all you need is their name and their SIN. That's all you need. And at that point, using UFile, you're able to net file the return. In the past, you needed the CRA would send a code. Okay, in order for you to be able to net file the return. That's been gone now for several years. So now all you need is their name and their SIN, and you could transmit that return through net file for your. There's no issue there. There's no other requirement.
Okay, Angela would like to know, how do I refile a report to report Rrsp that I have bought in 2019 and did not include in my 2019 tax return?
Okay, so she made a contribution of Rrsp in 2019, but never declared it. I'm assuming never declared it. So you have to do an adjustment. That's what's required. So the Rrsp has to be recognized in the tax year that it was contributed. Okay, so you have to file what's called an adjustment. You might be able to do this one directly in the My Account portal with a CRA. Okay, so you simply create if you already have a My Account account, if you're already with My Account with a CRA, then at that point you're able. You might be able to do the adjustment directly there. If not, we produce an adjustment form in UFile that you could produce, but you'd have to print it and mail it with a receipt to the CRA, and that takes time before they recognize at that point. If you're able to do it online with My Account, again, I'm not sure whether you can or not. Go and check. Go ahead and do that. But the long story short here is that you have to adjust the return. There's no choice. You can't simply grab that amount and all of a sudden claim it on your 2020 return. It won't work. When you try to pass it through NetFile, the CRA will block it because they see your receipts. Every single one of your Rrsp receipts has been submitted by your financial institution to the CRA. So they know which receipts you have. So if they don't see one for 2020, they'll simply refuse the transmission.
Okay. We have a question from Chad. He started a bookkeeping business.
Okay.
How much and where can I claim my startup costs, new computer, desks, etc.?
Okay, that's depreciation. So these are durable goods that you bought. So your computer and your desk, your office furniture, etc. These are not supplies. You can't deduct the full cost of them in the year that you bought them. These are durable goods that will last beyond 1 year. So therefore, these are depreciable. These are depreciable items. So you have to enter them as depreciable items. So in UFile, you're going to have a section for capital cost allowance when you're entering your business income and expenses. Okay, so you have to go into that depreciation and then choose the appropriate class. Off the top of my head, I believe a computer is a class 55. Your desk is going to be a class 8. Okay, so at 20%. So you have to enter them there as purchases in those depreciable capital cost allowance classes. So you have to put them in there.
Okay. Next question.
Mm-hmm.
Freeman wants to know, can I file a revised or change to a return for 2017 electronically on UFile?
Electronically, I don't believe a revised one. You can file one if you haven't filed one yet. But I don't believe you can file a revised 2017, an adjusted one. I don't believe NetFile is equipped for that as of right now. Okay, so in that case, but if you haven't filed your 2017, then yes, you could still file electronically your 2017 in that case.
Just a reminder right now, CRA, the NetFile service is not open as they're getting ready for the new tax season. So
true.
So I just wanted to let that know.
No problem.
Mr. and Mrs. Conda came back. My son goes to a private school, and thus there is a considerable tuition fee. He is in kindergarten now.
Okay.
He's 5 years old.
Yeah.
Can I use this expense for childcare at all? If yes, how long or until what age can I continue claiming the tuition expenses?
Okay. First of all, for tuition expenses, you cannot for the tuition tax credit because the school has to be a post-secondary level school, which means college, university. Okay. So right off the bat, you can't claim it as a tuition fee. As far as childcare expense, all you're allowed to claim is the portion of the fees that you're paying the school for childcare. In other words, for example, for lunch hour and for after school hours, if you pick up your child after the work hours. So, for example, let's say the school ends at 3:30, you pick up your child at 5:30 for those 2 hours. If there's an extra charge, you're allowed to claim those as a childcare expense. But the tuition fees of the school itself, because it's not a post-secondary institution, you are not allowed to claim.
Okay, I think I may have skipped one.
Okay.
Emily, how do I file for a deceased person where I have no financial information?
That becomes really tough if you don't have that information. You need it. I mean, you're going to have to contact the CRA and prove to them that you are the executor of the estate, and then ask them essentially for the documents that they have. Because pretty much every single slip that is emitted which is an official government slip, like a T slip, so T4, T5, T4 Rrsp, T4 RIFs, the government has a copy of those slips. Okay, so your best bet is you're going to need to send the will that proves that you're the executor of the estate. You're going to have to explain and therefore proving that you are the executor, and then from there ask the CRA for the documents. That's the only way. There's no other way. There's no other way around it.
Okay, Peter, I'm not quite too sure his question. Okay, he's saying thank you for taking the time to answer our questions. You're welcome.
Oh, you're welcome.
Since the pandemic proved we can work remotely, and I have the opportunity to couch surf my friends and colleagues at summer houses, I decided to rent 100% of my condo, which is still on paper my primary residence.
Yes.
Can that be a problem in the eyes of the CRA?
Oh, yes. Oh, yes, it is. Yes, it is. But thankfully there's an out. Okay, so the moment you've decided to rent your property, you've essentially now triggered what the government calls the change of use rules. Okay. And the change of use rules is essentially what you're doing is you have a deemed disposition of your property. Okay. So essentially, to the government, it's as if you've sold, quote unquote. You haven't actually sold. You haven't sold it to a third party, but to the government, it's essentially you've essentially sold your property to another person. Okay. And at that point, you have a taxable transaction to declare. Now, the good news is you have two recourses here. Okay. One recourse is you declare the deemed disposition, and then you declare the principal residence exemption. Okay, that's the principal residence designation. So you designate your property as a principal residence for the years that you were living in before you rented the property, and then your disposition is tax-free. Okay, that's one way. Another way is you don't declare the deemed disposition. And by the way, the T2091, which is the principal residence designation form, is in UFile. You can actually do that in UFile. Now, the other option is you cannot declare the disposition, okay, through a specific election, okay, and the election is under subsection 45.2. So I'm just going to type it in the chat, okay, the article of law, okay. So I'm just typing it for everybody in the chat. It is 45.2. I don't know if everybody could see that now, if they see 45.2. Okay. So it should pop up on the chat right now. So that you do through a letter. Okay. So you don't declare the deemed disposition, but you have to produce a letter, okay, where you stipulate to the CRA, okay, that you change the use of your property, but you are using the election under 45.2 to not do a deemed disposition. Okay, that's essentially what you do. Okay, but you have to submit this letter by April 30th of this year. Okay, in order for the government to get off your back. And at that point, you declare nothing until you actually sell your property. Okay, that's essentially what you would do. Those are the rules.
Okay, ready for next one?
Mm-hmm. Let's go.
Okay, Karen. CRB has an income threshold of $38,000. Does this include the SERB and the CRB payments? Is it gross or net?
So, okay, my understanding on this case is that it does not include the the clawback does not include the CRB and the CERB. I'm just going to go to the work chart right now, just to confirm that I'm telling everybody here the right answer. So it does not include the CRB. Okay, so it does not include the CRB itself, but it basically includes everything else, and it's usually based, I believe, on your net income, if memory serves me. The 38,000 is your net income, essentially. So when you cross over that 38,000, now you are subject to clawback on the CRB, not the SERB, by the way, not the CERB. There's no clawback for that, but there is a clawback for the CRB. Okay, and the actual benefits you received under the CRB are not counted. Okay, amongst for the clawback, they're not counted.
Okay, Joanna. I forgot to enter in 2019 year the Rrsp from January to February. Can I claim it this year? Where should I enter it?
No, same answer as the previous one. Your first 60 days of the year of a year count. You have to be declared in the previous tax year, which means you have to adjust your 2019 return. Okay, that's clearly stipulated in the Rrsp guide of the CRA. Okay, so unfortunately, in this case, you have to adjust your previous year. Check again, like I said, go to my account, see if you could adjust it directly there online. If not, you could get the adjustment form in UFile. It's the T1ADJ is the form, and you go in there, you declare it with your receipt, mail it to the CRA, and then wait for them to respond. Okay, and it usually takes a while, unfortunately, with these adjustments.
Can we do a little specification on that for you, for any, let's say for 2020, any Rrsp contribution you made January and February, you need to report it
in 2019
tax return
of 2019. That's how it works.
Correct, so, but you don't have to take the deduction though.
No, you're not required to. No, you're not forced to take the deduction. As long as you have room in your Rrsp and you're not over your limit, you're fine. But the key is though, what you're declaring on your return is March to December of let's take this year. Let's take literally this year. So March to December 2020 and January, February 2021. That's what you're declaring on your tax return in 2020. Okay, so your first 60 days of the following year, you have to declare them in the previous year. That's how it works.
Well, actually, you should say reporting.
Yeah, reporting. Yes, exactly. Yeah. Well,
Reporting.
you claim that you made the contribution, right? Yeah, you don't have to actually claim them as a deduction on your tax return. That's the
Okay.
difference.
Perfect. Okay, now let me see where we are. Okay, Jeff.
Yes.
How many years back can I apply a retroactive investment loss generated in 2021?
So you can go back 3 years, which means 2019, 18. Okay, as long as it's considered a capital loss. Okay, as long as you have it considered as a capital loss, then you could go back 3 years. If it's a non-capital loss, for example, business loss, it's the same rules. You could always go retroactively 3 years back. Again, it's the same form as I mentioned before. It's the T1A that you have to produce with the tax return.
Okay, Lisa. We sold our house last year and put as much as we could in a TFSA.
Okay.
Is the rest of the money taxable? Right now, it's in a bank account.
Well, it's all taxable, but it depends. It depends though. If this is your principal home, okay, if this was the home that you lived in, then you are entitled to the principal residence exemption. Okay, you have to designate your property for the principal residence exemption. You do that through UFile has the form in order to do this. You do this in the capital gains section when you choose real estate. Okay, and as long as you lived in that home, you never rented it throughout the time that you were an owner of it, then you are entitled to the principal residence exemption, and your capital gain is tax free. Okay, so you're not declaring, your gain is exempt. That's what the principal residence exemption is. Now, remember that your contribution with in a TFSA is non-deductible. Okay, remember, only your Rrsp contributions are deductible, not your TFSA contributions. Okay, now that's a disadvantage compared to the Rrsps, but the advantage of a TFSA is that when you pull out the money, it is entirely tax-free. Okay, that's why they call it tax-free savings account. While an Rrsp, when you start pulling out, now that income becomes taxable. Okay, so roundabout, that's essentially the answer there.
Okay, Mr. Islam.
Mm-hmm.
My friend's son, born in the USA, however, living in Canada for the last 10 years.
Okay.
2020, he became 18 years and started some income in Canada. Should he file in the US or in Canada?
He's a Canadian resident. I mean, this sounds like he's been a Canadian resident for 10 years from the sounds of it. This looks like a person who has established permanent residential ties to Canada. Remember, it doesn't take citizenship, unlike the US, to be required to file a tax return in Canada. Now, in the US, it doesn't require citizenship either. If you stay a certain number of days in the US, then you are required to file a tax return there, unless you use a treaty exemption, okay, between Canada and the US. But that child in this case, from the looks of it, to me, looks like his family was in Canada. He's been living in Canada all these years. This is a resident of Canada. Okay, so that means that the income is declared in Canada. Now, there are some rules in the US, if he's a US citizen, that they still have to file a US return regardless, because they have citizenship in the US. That I cannot speak to. I'm not a US I'm not a US tax specialist. Okay, but that you'll have to check with somebody else. But I know for a fact in Canada, they have to file a tax return in Canada. That person is a resident of Canada, pure and simple.
Okay, I have a question from Deepa. I hope I said your name right. So their question is, what is the difference between a T4A and a T4E? I guess both amounts are taxable.
Yeah, well, T4A is basically picture in your house. You must have some sort of drawer or a box where you stick pretty much anything that you don't know how to catalog. That's a T4A. Okay, T4A can be anything and everything. A T4E is purely employment insurance, anything that relates to the employment insurance programs. So you'll see maternity benefits there, paternity benefits there, employment insurance, and so on. Okay, a T4A, I can't even answer the question because it's literally everything and anything. Okay, so when the government doesn't know where to stick an amount, they put it in a T4A. It's as simple as that. Okay, so literally picture in your minds, you must have a drawer in your house where you just stuck a bunch of stuff you don't know where to catalog. Okay, that's a T4A. That's essentially what it is.
You have one?
Oh yeah, unfortunately, yes. Yeah. That's why I use the analogy. I'm sure everybody does.
I won't answer that. Okay, we have a question from Massimo. I am contributing to my granddaughter
Okay.
preschool. Can I deduct the fees? She lives with my daughter.
We might have to be a little bit more precise than that. By contributing, what do you mean exactly? Are you paying for the childcare expense? In this case, you have to be a little bit more specific on the question. In this case, to me, let's assume that it's that. Okay, for a second, if it's childcare, you'd have to show that you are the main supporting person of the child, and you wouldn't be able to make that argument because your daughter, it's a daughter, right? What's the family link? Between the grandchild and Massimo?
It's his daughter's daughter.
Okay, so your daughter would be in this case the main support person, so you can't deduct it as a child care expense. Okay, in that case, beyond that, yeah, I mean, you have to show that you're the supporting person. There's nothing else I can think of off the top of my head that you'd be able to deduct. Okay, for that. Now, yeah, I can't think of it honestly.
Okay, we have two questions related now to the working from home. Okay, Amy wants to know, does the flat rate deduction apply to self-employed people as well?
No, it's purely for employees. Okay, so remember that if you're self-employed, you were already entitled to deduct your home office expenses. You were already entitled to it. Most employees were not entitled to this. That's why the government introduced this temporary flat rate method. So that's purely for somebody who's working, okay, and who's required to work from home due to COVID. So no, not for self-employed. Then?
Okay, Brian wants to know, is the temporary flat rate credit only for work from home instead of office, or what if my job is already working from home?
No, you what's called, and remember, the temporary flat rate method is the fact that you were required to work from home due to COVID. That's the criteria. If you were already deducting home office expenses because you were already entitled to employment expenses, then you continue with that method. The temporary flat rate method is the fact that you were required to work from home due to COVID. If you were already there, then you're not claiming the flat rate method at that point. It's only for COVID reasons.
Okay. Mr. Patel, I am going to skip over a little bit your question here because he wants to know a screen-by-screen demonstration regarding with foreign income sources. Okay. I think that's going to have to be a little bit more specific, or we're going to have to get you in touch with somebody from support for that. Okay. Yeah. All right. And I will send you after a message. Don't worry. Okay, Kathy, my stepmother is living in a retirement home. I am her person. I pick up her groceries, banking, I do her banking and take her appointments, etc.
Yeah.
She lives half hour from me. Is there anything I can claim? She's 90, but is independent.
Not offhand, no. I mean, the fact that she's if she lived with you, then you would be able to claim her for the caregiver amount because it's likely at that age you'd be able to prove infirmity. Okay, so I'm sure a doctor would be able to write you a note easily saying that the person has an infirmity at that age. But beyond that, no, you can't really deduct any of those type of expenses because she's already in a home. So she's being taken care of in that residence. That's how the government would consider it. So not likely.
Well, they say she's pretty much independent.
And she's pretty much independent, yeah.
Independent living, except she does her errands and her banking and all that.
There's not much you could claim there, no.
Okay, Devin. As a reference from my earlier question, the child in question is my stepson. We married in 2019 and claimed him as a dependent last year. Does that still mean he can no longer claim him since his mother remarried?
Can you repeat that a little bit again? Because I kind of lost track a little bit of the scenario.
Okay, Devin said, as a reference to my earlier question.
Okay, yeah, go ahead.
The child in question is my stepson.
Is your stepson, okay? Okay.
We married in 2019.
You married in 2019?
Him as a dependent last year.
You were allowed, yes. 2019 you were allowed. 2020 you're no longer allowed because you've been with a spouse throughout the year. Okay, so automatically now you're no longer eligible for the eligible dependent amount. That's the basic criteria. At one point in the year you were without a spouse, you don't meet that anymore. So you can't claim your stepson in that case.
Okay, Anna. The past 3 years, I was making monetary donations to a certain organization, so I have been carrying forward.
Yes.
2020 was the last year for my donation. When is the best to claim them?
When you need them. If you have an amount owing on your tax return, do it. If you still have federal tax to pay, even if you're getting a refund, remember, it doesn't mean you're getting the maximum refund possible. So I mean, if you can claim it and use it at that point, then no, do it. I mean, claim it now as soon as you can. Remember, you're deferring. Remember, you're deferring money that could be in your pocket doing something useful for you today. So no, claim it as soon as you can, as long as you have federal tax to pay and provincial tax to pay. As long as you have those two tax to pay, claim them. There's no reason to keep them.
Okay, next question. Kathy, you were saying that your stepmother that's living in a retirement home has a disability?
But it doesn't matter. They don't. Okay, if they have a disability, then it's I mean, it's a little bit different because then you might be entitled to the caregiver amount, because with a caregiver amount, you don't necessarily have the requirement of living with that person. Okay, so at that point you can, as long as you could prove an infirmity. But in the original question, it was she's independent in good health. So at that point, there's nothing you can claim. Now if she's not, then the old strict criteria where you had to live together is no longer applicable. So at that point, then yes, you might be able to claim your mother for the caregiver amount. You'd have to though confirm with the CRA just in case.
Okay, next question from Mark. Can I claim my 16-year-old daughter psychotherapy sessions that my insurance does not cover?
Yes, as a medical expense. That's where you claim them. So whatever your insurance is not covered, what's called that type of therapist, psychiatrist, or I can't remember now the other one. What's called that is usually a recognized specialist for the CRA. So the difference that your insurance did not pay, claim it as a medical expense.
Okay, next question from Chad. Claiming your life partner as a dependent needs an infirmity certificate or not?
No, your life partner. So this is your spouse for the government. Okay, the term that the government is going to use is your spouse. So your spouse, no, as long as their income is below a certain threshold, and the threshold is I think 13,000 and change. I can't remember off the top of my head now. It's 13,000 and 13,200 and something. Anyways, it's around 13. It's a little over 13,000. As long as your income is below that amount, then you could claim your life partner for the spousal amount. No problem there. No need for infirmity or disability.
Okay. Next question is how to enter Serb.
Serb is going to come from what is it, T4E or T4A? I think it's a T4A,
T4A.
actually. Yeah, it's a T4A. So you're going to get a T4A box 11. I think I answered it before earlier in the call. So again, what you're going to do is in the interview setup in UFile, make sure you tick the box next to the pension income and other income where it's going to list for you a T4A. Okay, it's in the pension section. Okay, so tick the box there, click next, and then go to the T4A slip. And within the T4A slip, you're going to see a section called Other Information, or box 28 plus. Okay, so you go in there, click on the drop-down menu, and choose the relevant code that's going to be indicated for you on the T4A. It's usually, I believe the answer was 197 last time. That's what I'd seen.
Well, they have a drop-down menu and they choose whatever box is.
Yeah, but it's in box 28 plus that they choose. They go to the drop-down menu.
Okay, Darren. When completing a simplified T1135 form for the joint account that is held in both my wife's and my name.
Yeah.
Okay, twofold question. One, is the adjusted cost base minimum threshold 200,000 Canadian, meaning 100,000 each?
Yeah.
And two, this is a joint account, is our only foreign investment. Would both of our 1135s be identical for our individual UFile tax submission?
Yes, if it's a joint account, obviously you're splitting it down the middle, which means whatever value that account has, whatever cost, whatever adjusted cost base that account had at one point. Because remember, the threshold, so for the simplified 1135, it has to be between 100 and 250,000 Canadian, okay? To get to in order to qualify you for the simplified one, where you don't have to list your properties, you just tick the boxes next to the types of properties that you have. If it's a joint account, of course, you split it down the middle. And if in each account it's above 100,000 Canadian as far as the cost, then yes, each one of you will produce essentially identical T1135s because it is a joint account in that case. And with the simplified, it's really simple. You just tick a box next to the type of asset that you have. It's as simple as that.
Okay. Next question from Sean.
Okay.
I have an outstanding balance on my home buyer's plan of
Okay.
1,500.
Okay.
Is there any way to pay this back fully, or will I have to wait to receive an assessment?
No, you could pay it fully by putting 1,500 in your RRSP and then designating that 1,500 as a home buyer's plan repayment. So you can repay it in full that way. So the government tells you have a minimum to pay in your home buyer's plan. They don't, so they give you a floor, but they don't give you a ceiling. Okay. So in other words, if you have 1,500 left, you want to simply wipe out that debt, because it is a debt to your own account. That's essentially what the home buyer's plan is. You're borrowing from your RSP to purchase a home, and then you pay it back in 15 years. Okay. With the 15 installments. So if you want to make one lump sum payment, you absolutely can. Just contribute. Make sure you contribute 1,500 in your RSP and designate the full 1,500 as a home buyer's plan repayment, and then it's paid off.
Okay, Diane. Her question is, how to claim medical receipts paid in the U.S. and in U.S. funds? Can I convert them to Canadian funds? If so, how?
You'd have to do it manually. Okay. So you would have to convert it to Canadian funds. Absolutely. Okay. That is the rule. That is the rule in this case. You would have to convert them into Canadian funds. And within the program, there is no conversion tool for medical. You would have to simply convert it. You can go to the bank. If you type in Google, if you go to Google and you just simply type in average exchange rate Canada 2020, they'll quote you right away what the exchange rate is. It's very, very simply done.
Okay, back to Alex's questions about the U.S. winnings. He needed a little bit more clarification.
Yep.
Okay. He wants to know, do I have to do a U.S. tax return or just show the 25% that was withheld as foreign tax paid? Is that what you mean?
No. First of all, forget anything on the Canadian tax return. Remember what I mentioned. That income is non-taxable income in Canada, okay, which means you can't claim the foreign tax credit. The government cannot give you a credit for an income it considers as non-taxable. So forget the Canadian return. You would have to file a U.S. return and try to claim a treaty exemption if there is one, okay, which I'm going to be honest with you, I don't know off the top of my head. But you would have to file a U.S. return to be able to recoup that money back. The Canadian return and the Canadian government will not give you anything for that 25% that you were withheld on your lottery winnings.
Okay. Jacinta, I sold a property that was my primary residence prior to renting the property for a few years. Can I claim principal resident exemptions, or would I need to fill out a special form? Is this available?
Can you repeat that first part? I wasn't sure about the sequence. So she had a home.
I sold a property that was my primary residence prior to renting.
Prior to, she's renting now.
The property for a few years.
Yeah, but she didn't sell then. She still owned it when she rented it. That's a change of use. Then that sounds like a change of use to me. She changed the vocation of the property. So she was living in it, then she rented it, and now she sold it. That's my understanding. So in that case, normally in the year that you converted, you're supposed to declare a capital gain, or you would have elected under 45.2 to not declare the capital gain. Okay. So in that case, yes, the years that you were within it as a principal residence, you designate as a principal residence. Okay, the years you were living in it is a principal residence. But remember, I'm not sure what happened though the year that you converted the property. Did you declare the change of use, or did you defer the change of use under 45.2? That could get a little bit complex with the CRA because you haven't declared a taxable transaction to them. So yeah, that's where I'm not sure, of the question.
Okay, Anna is following up on her previous question, said
Yep.
her employer will be issuing a T2200
Perfect.
tax form because for working from home.
Yeah.
Will she be able to claim this and the simplified one that the CRA introduced?
It's one or the other.
One or the
exactly. You either take the detailed method, which is where you itemize your expenses, and then you need the T2200S from your employer, or you go with the temporary flat rate method, and then you don't require the T2200S. Okay, so that's essentially, those are your options, essentially, when it comes to that.
Okay, Massimo gave a little bit more details. He's saying he's paying for his granddaughter's preschool, which is a private school. Can he deduct it from his taxes as he's retired and living with a pension, a RIF, and an investment?
No, because a preschool is not considered a post-secondary educational institution. Remember, tuition fees are only eligible for colleges and universities. Okay, that's the only schools, or vocational schools, for example, like professional schools like electrician, plumbing, things like that. Okay, anything below that, anything else is not eligible to be deducted. Okay, so unfortunately, there's that, and you can't deduct it as childcare either. Let's say there was a childcare component to it, you can't, unfortunately, for the simple reason that you are not the primary support person of that child. So it's your daughter. So at that point, you can't claim it either.
Okay, next question, Gustavo. He wants to know, can you claim the cost of constructions to turn your basement into a legal rental suite?
The way you do it is by adding to the value of your property. You don't deduct it as repairs or maintenance. Okay, you can't take it directly off your net income. What you do is when you converted that property, that portion of your property into a rental, well then you assign the value to that property. Okay, so let's say let's say half of your house you converted into a rental property. Okay, your house is worth $300,000. That means now you have a value of a rental property of 150. The renovations you did to convert it, you added to the 150. Okay, so you add it to the value and then you depreciate. That's what you do. You're allowed a depreciation cost on the renovations, but you're not allowed to deduct them directly off your net income. Like dollar for dollar, in other words.
Okay, we have a question from Karen.
Mm-hmm.
My daughter is 18 this year. Is it advisable to file a return even if she doesn't have any work income? She's still at school.
Yes, it's advisable because chances are she might already be eligible for the tuition fees, which she has to start declaring. She won't be using them, but they have to be declared in order to carry them forward, or you, the parent, can claim those amounts on your own tax return. Okay, that's number one. Number two, eventually your daughter's going to be eligible for the GST credit. Okay, in order to get the GST credit, there has to be a filed tax return in the CRA's hands. Okay, in order for them to be able to pay out that quarterly payment. So yes, absolutely file a return. Even if it's a nil return, it doesn't matter. File it, because there's certain amounts. One, your daughter you'll ensure your daughter gets the first payment that she's entitled to for the GST. And two, she'll be able to declare her tuition fees and either carry them forward or give them to you. Okay, that's essentially what you would do.
Okay, we have another question from Diane. She said a spouse passed away this year.
Okay.
Do I wait and file the spouse's tax return next year?
It's a good question, because the deadline, I believe in the first, you could wait actually if you want to, unless you need the tax return to clear all the assets to the beneficiaries, and then you might be forced to produce like a preliminary 2021 return. But legally speaking, on the income tax, as far as the Income Tax Act, you can wait till next year to file the return, since they've passed away. I think they probably passed away. Obviously, they passed away in the first 2 months, right? So at that point, you can go till April 30th of 2022. At that point.
Okay. Shannon, I started an online business in 2019 and didn't do taxes on it, and want to do that this year. How would I enter that in UFile, or should I just hire an accountant?
What's the income? I'm sorry, I missed that.
No, she didn't give an amount of the income itself. She said she started an online business in 2019.
Ah, okay, so self-employed then. Okay, so she's got an online business. So that means self-employed. No, you could do that with UFile relatively easily. If you're afraid of being able to claim the income and expenses, then yes, by all means, go to an accountant. But UFile does support self-employment income, okay, in all versions, by the way. That's the one difference with our product, is that we don't charge a tiered product. You don't have to pay extra to get certain types of tax returns done. With UFile, no matter what version you buy, everything is included, okay? So at that point, you can produce self-employed. It shouldn't be too complex, to be honest with you, but if you're worried, you go to an accountant. Just go be on the safe side.
Okay, Freeman wants to know, can a rental income and bank interest be claimed by one spouse when the house and bank account are both co-owned by the couple?
No, you can't simply choose because it's more beneficial for one spouse to claim expenses versus the other. The moment, legally speaking, that the property is split in two on the tax return, you have to split it in two. That's just how it is. You can't simply in a discretionary way just decide that. You can't do that.
Okay. Next question. Is there an area on the Canadian tax form that I can claim support payments for my children?
For your children, no. Support, if you're talking about alimony, if we're talking about something like alimony, if it's directly linked to your children, they are non-deductible. If you're making support payments to an ex-spouse, those are deductible, okay, on your tax return. If it's for a child, the answer is no. These have been non-deductible now for many years, since 1997, actually. So, okay, I think we could go. Let's go a little bit longer because I think we've got a bunch of questions that we didn't answer yet. Let's go a little bit, and then we'll close up shop. This is great. This is great feedback, everybody. This has been awesome.
Okay,
keep going.
Jack wants to know, okay, we sold property we owned in the US and paid a withholding tax upon escrow.
Yeah.
Do we need to pay a capital gain on our Canadian taxes, or do we need to file a US return?
Okay, so Canadian resident sold the property in the US, right? And there was a withholdings at source there. So yes, the capital gain is taxable in Canada. However, whatever tax was withheld there in this, you can declare it for the tax credit in Canada. So Canada will give you a credit for the fact that you already paid a tax in the foreign country. So you're not going to get double taxed on that capital gain, but the capital gain is taxable in Canada. Okay, so yes, remember the basic rule. This is actually Section 2 of the Income Tax Act. What it tells you is we are all taxed on our worldwide income, regardless where you gained it. Okay, so you have to declare that income in Canada.
Okay, I don't know if you needed to add anything, but Jacinta did confirm that yes, she changed the use.
And an election was done, right? And declared change of use. Okay, so you declared the change of use.
Yes, she did.
So then, if you declared the change of use, you would have declared. Then that would have been the year you would have done the principal residence exemption. It would have been that. It would have been that year. That's when you would have done it. Okay, so if you change, that's when the principal residence designation should have been done. Okay, it's in that year. Now, if you took an election, that's different, okay? If you took a 45-2 election, then you're declaring the capital gain, and now you're designating the years that you lived in that property as a principal residence, okay? And you could even go 4 years more with a 45-2 election, actually. You could even do extra, you could designate an extra 4 years after the change of use when you do the 45-2 election.
Okay, I think that covers most of our questions for today. Actually, I want to give a shout out to one of our former colleagues, Joanne. She's just put a comment that she says hello to both of us. So,
all right, hey
Joanne, it's very nice to hear from you.
Nice to hear from you.
Now, if anybody has some additional questions or you need some support, feel free. You could send a message through Messenger for UFile, and I will redirect your question to the support team. Jerry, any other words of wisdom you want to give?
Get organized. I always say this all the time. Keep your documents sign up to My Account CRA. I can't recommend that more strongly than I do. All your tax information is there, including your past notice of assessments, and it's super easy to do. You can log in with your bank credentials. Okay, that's how simple it is. Okay, so go ahead and sign up if you haven't done so already. Go to My Account and sign up. Okay, and again, final word. Remember, employment expenses, temporary flat rate method. Okay, you don't require any special forms, no conditions of employment. You have the choice of taking the $2 per day up to $400 maximum, or you take the detailed expenses where you itemize your expenses, but then you need the T2200 form. Okay, the T2200S form. Okay, just as a final thing, so that everybody is aware of how that works. I think that's it. That's all. That's all there is.
Okay, the video will be posted on the Facebook page. It will be available for your viewing. And stay tuned. We may be doing, we will be doing more Facebook Live events. So
absolutely.
Keep in tune.
All right.
So that's it for us today. Thank you very much, everybody, and have a good day.
Take care, everybody. Bye-bye.
Bye.